6 months ago, I started managing my crypto portfolio using AI tools exclusively. Today I'm showing you everything, every number, every decision, every mistake, and the final balance. No hiding, no cherry picking. This is what AI-assisted crypto investing actually looks like for a regular person. Before the reveal, let me recap the strategy I've been running so the numbers make sense. This is portfolio transparency you rarely see on this kind of channel. Months 1-2, building phase. Started with $2,000, AI recommended split, 60% BTC, 25% ETH, 10% SOL, 5% FET. DCA added $200 month. Auto invest set up on Coinbase, hardware wallet purchased and set up. No active trading, pure hold with monthly rebalancing triggered only if any position drifted more than 10% from target. Months 3-4, the volatility test. After 2 months of steady, almost boring accumulation, the market decided it was time for my first real test. I woke up one Tuesday morning in month 3 to a sea of red. Bitcoin, the cornerstone of my portfolio, had plummeted. It wasn't a gentle dip. It was a gut-wrenching 14% drop in a single day. My entire portfolio was down 11%. Every instinct screamed at me to sell, to cut my losses before it went to zero. The little voice of panic in my head was loud, telling me, "This is it, you got in at the top, get out now before you lose everything." It's a primal fear, and it feels incredibly real in the moment. This is precisely the kind of emotional decision-making that torpedoes most new investors. Before I could let that fear take over, I forced myself to stop and stick to the plan. Consult the AI. I opened my dashboard and ran the analysis. The AI's recommendation was immediate and clear, a stark contrast to my own internal chaos. It said, hold, do not sell, but it didn't just give a command, it provided the rationale. The system flagged that while retail sentiment was in extreme fear, on-chain data showed significant accumulation by long-term holders. It cross-referenced the pattern with historical data, noting that similar drops outside of a major bear market cycle had an 82% probability of recovering within the next 30 to 45 days. This was the data-driven anchor I needed. The AI was seeing a statistical opportunity where my gut was only seeing a threat. Then came the second part of its advice. Consider temporarily increasing your dollar-cost averaging contribution. This wasn't just about holding on, it was about leaning into the volatility. The logic is simple. If you believed in the asset's long-term value yesterday at a higher price, you should be even more confident in buying it today, at a 14% discount. Increasing my DCA would allow me to acquire more Bitcoin for the same amount of capital, significantly lowering my average cost basis. This is how you turn a scary downturn into a strategic advantage. It's a concept I understood intellectually, but the AI provided the unemotional, data-backed confidence to actually execute it. I followed the advice. I took a deep breath, consciously ignored the bright red sell button that seemed to be calling my name, and navigated to my automated investment settings. My standard plan was $200 a month. Based on the AI's analysis, I decided to double down. I kept my automated $200 purchase and manually added another $200 right then and there at the bottom of the dip. So I added $400 that month instead of $200. It felt like walking into a fire, but I was trusting the system I had put in place. The next few weeks were nerve-wracking. The price didn't immediately bounce back. It traded sideways, testing my patience. But then, as the AI had predicted, the recovery began. By the middle of month 4, the position had not only recovered its losses, but it had pushed into new highs for my portfolio. That extra $200 I invested near the bottom was already up over 20%. This was the most valuable lesson of the entire experiment. The AI's emotional discipline saved me from a mistake I almost certainly would have made on gut feeling alone. I would have either sold at a loss or at best sat on the sidelines in fear, missing the recovery and the opportunity to lower my cost basis. It proved that a systematic, data-driven approach isn't just about maximizing gains, it's about managing your own psychology to prevent unforced errors. Months 5-6, results and benchmark. Alright, we've reached the 6-month mark. The experiment is complete, and it's time to pull back the curtain and look at the final numbers. The goal was to see if an AI-assisted strategy could navigate the crypto markets more effectively than a simple, passive approach. We started with an initial investment and consistently added capital each month, letting our AI co-pilot make the key allocation decisions. So, after half a year of disciplined investing, rebalancing, and weathering market volatility, where did we land? Let's break it all down, starting with the top-line figures. Over the entire 6-month period, our total capital invested was $3,200. That consists of the initial $2,000 lump sum we started with, plus 6 subsequent contributions of $200 each month through dollar cost averaging. This consistent investment is key, as it represents a realistic strategy many people use to build a position over time, buying in at different price points and smoothing out the average cost. As of the end of month 6, the final portfolio value settled at $3,091. This gives us a total net gain of $691. In percentage terms, that's a return on our invested capital of 21.6%. Now, a positive return is always welcome, but this number doesn't mean much in a vacuum. To truly understand the performance, we need context. We need a benchmark. For our benchmark, we chose the simplest, most popular strategy in crypto, just buying and holding Bitcoin. We simulated what would have happened if we had taken that same $3,200, the same $2,000 initial investment, and the same $200 monthly additions, and put it all into Bitcoin on the exact same days. Following that strategy, our $3,200 investment would have grown to $3,540. This represents a total gain of $340, or a 10.6% return. So, let's put those two results side by side. Our AI-managed portfolio delivered a 21.6% return, while the passive Bitcoin-only strategy yielded 10.6%. This means our AI-assisted approach outperformed the simple Bitcoin DCA strategy by 11 full percentage points. In dollar terms, our portfolio generated $691 in profit, whereas the benchmark would have only generated $340. That's more than double the profit for the same amount of capital invested. This outperformance didn't come from one lucky trade. It was the result of systematic rebalancing. For example, back in month 4 when Solana had a strong run-up, the AI prompted us to trim that position and reallocate the profits into Ethereum, which was lagging at the time. A passive Bitcoin-only strategy would have missed that opportunity entirely. The AI's role was to actively manage risk and rotate capital, which in this specific 6-month window proved to be highly effective. Now, it is absolutely crucial to state that this is just one data point over a specific 6-month period. This is not investment advice, and it is certainly not a guarantee of future performance. A different time frame could have produced a completely different result. The market could have behaved in a way that favored a simple Bitcoin holding strategy. But while it's only one data point, it is an honest and real data point. We tracked every transaction, accounted for fees, and followed the strategy to the letter. The numbers you see are the real-world results of this documented experiment. It suggests that with the right parameters and disciplined execution, an AI-assisted approach can potentially offer a significant edge. I'm going to keep running this experiment and reporting back. The portfolio tracking tool I use, CoinStats, is in the description. Subscribe to follow the journey, and tell me, what does your 6-month crypto return look like? Drop it in the comments, let's compare. 6 months ago, I started a quiet experiment. I wanted to see if it was possible to remove emotion, hype, and gut feelings from crypto investing. So, I handed over the reins. I started managing my crypto portfolio using AI tools exclusively. Today, I'm opening up the books and showing you everything. Every number, every AI-driven decision, every mistake, and the final balance. No hiding, no cherry-picking the good parts. We're going to cover the exact strategy I programmed the AI to follow, the month-by-month log of its trades, and a case study of how it handled a significant market drop. I'll even give you a quick demo of the tools I used, break down the hidden costs like fees and taxes, and most importantly, benchmark this AI-managed portfolio against a simple Bitcoin-only strategy. We'll look at my biggest mistakes, what I learned about risk management, and I'll finish with a lightning round of your most common questions. So, stick around. Before the final reveal, let me recap the strategy I've been running so the numbers make sense. The goal was to create a rules-based system that could operate without my daily intervention. First, asset selection. I chose a core of 40% Bitcoin and 30% Ethereum for their relative stability and market dominance. Then, 20% went to Solana for its performance and ecosystem growth potential. The The final 10% was allocated to Fetch.ai, or FAT, as a speculative bet on the AI crypto narrative itself, a bit of a meta play. The plan was simple: start with a $2,000 initial investment, then dollar cost average, or DCA, exactly $200 on the first of every month, split according to those percentages. The AI's primary job was rebalancing. The rule was, if any single asset's portfolio weight drifted by more than 5% from its target, the AI would automatically execute trades to bring it back in line. This forces the system to take profits from winners and buy more of the underperformers. My risk was capped at my total investment. No leverage, no margin. The first 2 months were quiet. The AI simply executed the monthly $200 DCA buys and made one small, rebalancing trade as Solana slightly outperformed. Then, in month 3, we saw a market-wide dip. Bitcoin dropped about 15% over a week. This was the first real test. Instead of panicking, the AI's logic kicked in. Because Bitcoin's portfolio weight dropped below its 40% target, the rebalancing rule triggered a buy order for Bitcoin, funded by trimming a small amount of the other assets that hadn't fallen as hard. It was buying the dip, automatically without any emotional hesitation from me. The main tool I used for this was CoinStats. It allowed me to connect my exchange accounts and wallets, and crucially, to set up the automated rebalancing rules. The workflow was straightforward: define the target allocations, set the deviation threshold for rebalancing, and enable the automation. I also set up alerts to notify me whenever a trade was executed, just so I could keep a log. It's important to talk about costs. Over the 6 months, I paid approximately $45 in trading fees and experienced about $30 in price slippage or spread. I tracked these manually in a spreadsheet. For taxes, in my jurisdiction, every trade is a taxable event, so that rebalancing creates a tax liability, which is a key friction to consider. Now let's talk benchmarks. How did this AI strategy actually perform against just buying and holding Bitcoin? If I had taken the same amount of money, $30,200 total, and just bought Bitcoin with it on the same schedule, that portfolio would be worth $3,478 today, a respectable gain of $278, or 8.7%. Not bad, but how did our AI do? Total invested over 6 months, $3,200, which was the $2,000 initial deposit plus 6 months of $200 DCA. The current portfolio value, after all the trades, fees and volatility, is $3,891. That's a total gain of $691 for a 21.6% return on the capital invested. In this specific 6-month window, the AI-managed portfolio outperformed the simple Bitcoin DCA by nearly 13 percentage points. But it wasn't perfect. My biggest mistake was setting the rebalancing threshold too tight at 5%. This led to more frequent trades and higher fees than necessary. A 10% threshold would have been more efficient. I also learned the importance of security hygiene. Even with an automated strategy, I moved my long-term core holdings to a hardware wallet, only keeping the trading portion on the exchange. And finally, I learned that the true value of the AI wasn't just the return, it was the time and mental energy I saved by not having to watch charts all day. It enforced discipline. Now for a quick Q&A. Is this financial advice? No, absolutely not. This is a documented experiment for educational purposes. What if the market crashed? The AI would continue to follow its rules, buying into the crash to rebalance, which is a high-risk maneuver. Can you do this with less money? Yes, the principles apply to any amount. Why not just hold? Holding is a valid strategy, but this experiment was designed to test active rebalancing. So there you have it. 6 months of AI-managed crypto investing, completely transparent. If you found this breakdown valuable, consider subscribing for future experiments. And I'm curious, what has your return been over the last 6 months? Let me know in the comments. Remember to do your own research.